intend to cover 6 items, time permitting. 3 of them are related to certain reports and updates by OECD. One relates to the globe rules and what is the broad change from what was proposed earlier. Malaysia has brought out certain guidance on R&D expense claims. Let's try and understand very briefly what this is, and time permitting, what is the controversy around the transfer pricing issue on interest payments from Australia as a part of Singtel's case. Now, the OECD has updated TP guidelines and released it in 2022. Now, what does this capture? What is the change and what does it capture? The TP guideline is a document that provides the methodology, the approach that can be used while determining valuation that two multinationals have to use in case of cross-border transactions from a taxation standpoint. Is there anything new in this document? And if there isn't, to the guidelines vis-a-vis the prior version. The three changes pertain to the updated approach on using transaction profit split method and how do you apply hard to value intangibles. These are two approaches that were finalized and released in June of 2018. These have now been built into the transfer pricing guidelines. In addition, in 2020, there was additional TP guidance on use of financial transactions. This document synthesizes and consistently has built in all these three changes, and wherever required, the necessary changes have been made across commentary and is now available in a synthesized form. The OECD has also released a second batch of updated TP profiles. What is this and who would find use for this? TP profiles capture certain up-to-date harmonized information about TP legislation relating to the countries which are captured in the document. They would talk about what are the ALP methods that are acceptable, what is the comparability analysis that can be used, how can intra-group services be priced, how should financial transactions be treated, is there specific clarification in the domestic law on the treatment of these transactions, what are safe harbor rules, what are approaches to resolving and avoiding disputes. These are all questions that are answered by each of the countries as a part of the profile. An updated document has been released. As on date, 63 countries, profiles for 63 countries are available. There are 3 countries which have been added to the document, and there were a bunch of countries which are listed on the screen in front of you, where updated information has now been made available. Very briefly, the history is that these country profiles have been available from 2009. In 2017, there was significant modification to the country profiles, factoring changes in the BEPS reports. In 2021, the first set of update was released, and in 2022, additional set of countries have been updated and released. So for a person practicing TP, if you would, or managing TP, if you would like to understand information across countries, this could be a great reference document and a great starting point. There's also been a report on spontaneous exchange of information. BEPS Section 5 has a minimum standard on spontaneous exchange of information on tax rulings. What does this do? This is to enable tax administration with timely information on rulings that may help avoid or prevent any kind of BEPS action or BEPS activity. There is a requirement that certain type of rulings have to be mandatorily and spontaneously exchanged between jurisdictions. These relate to rulings relating to preferential regimes, unilateral APA arrangements, wherever there is a ruling providing for a downward adjustment of a taxable profit, rulings on PE, and related party conduit rulings. So if there is a country which has ruled on any of these matters, this information has to be shared with the country of residence, and that may enable the tax administrator to take action and preventive steps. What are the key findings of this report? There are what we gather from the report is that there are 22,000 rulings that have been issued since 2010. There have been over 41,000 exchanges between jurisdictions. There were over 131 jurisdictions that were reviewed, and in 95 jurisdictions there was no recommendation. Out of the recommendation for India, the there is a fairly innocuous observation, which is to say that India experienced delays in exchanging information on future in exchanging APAs, and the recommendation is that there should be an attempt made to exchange this as soon as possible. The next update I have is a change around the globe rules. Before I dive into what the changes are, this is a topic in itself. So I thought I'll briefly set out the context of the change, what is the broad change, and leave it at that. This may require a whole session or a few sessions to really understand the details around the rules. The objective and purpose is not to do a deep dive and understand all nuances, but at a high level, what is that is sought to be done. There were 15 action reports that were finalized in 2015. Thereafter, BEPS 2.0 focused on addressing challenges that arise from digitization of economies. And as a part of this process, 135 countries have come together, which represent about 95% of the global GDP, in what is called as a two-pillar solution. Pillar 1 is sought to address the profit allocation rules and assign a greater taxing right to market geographies. And Pillar 2 talks about new global minimum tax rules. The rules that have been released have been around Pillar 2 and how this needs to be administered. These rules on under Pillar 2 are also called as Global Anti-Base Rules, or abbreviated as GLOBE rules. What is the change and what is that the rules seek to address? The new global minimum tax rates for MNEs has been agreed at 15%. Minimum tax, how do you calculate what is minimum tax? You would look at two things. One is look at what is the profitability of the entity and what is the tax that is paid in each of the geographies. And does the tax paid divided by profit, is it below 15%? In which case, certain adjustments or certain taxes would need to be paid in another geography. Whom or where would this apply? This would apply broadly to cases where CBC applies. The threshold is similar with certain adjustments. The rule contemplates two interlocking rules. One is called the income inclusion rule, and the other is a backstop or a preventive mechanism called undertax payment rules. Very simply put, if in the event a particular jurisdiction has a rate which is lower than 15%, then the income inclusion rules will kick in. That would mean that the overseas holding entity, that the ultimate parent of this entity, would now include the income of this entity and pay the differential tax or the shortfall in taxes. There is a backstop called undertax payment rule. In certain instances where the income inclusion rule is not resulting in an income pickup, if there is a payment by an entity to if there is a payment to an entity in a geography which has a tax rate lower than 15%, then the payment may be disallowed by the geography making the payment. So there is a check and a balance that this rule now seeks to introduce. In addition, there is something called a subject to tax rule, which is to enable certain source geographies to apply a different withholding tax rate where the income is taxed at a rate lower than the minimum tax rate. What documents have been released? There are a set of 4 documents. One is the model rules on the globe rules, pillar 2 globe rules. There are 2 documents which summarize what the rules, the entire set of rules say in 5 pages. And there is something called a fact sheet, which provide an overview of how the key operating provisions of these rules work. There is also a lucidly written FAQ in about 6 pages, captures, raises multiple pertinent questions and answers them. What documents are to be issued? It's in some sense a work in progress. A part of the rules or the rules address a part of the issue have been released. There are a whole host of documents and rules and treaties that and commentary that one would need to read this with. Visualize this similar to MLI and the commentary with that. The text of the rule has been issued, but the commentary around the model rules is yet to be released. Likewise, I talked about 3 things. One is the income inclusion, the under tax payment, and the subject to tax. These are 3 different mechanisms to address a certain amount of minimum tax. The rules around subject to tax and the commentary around that is yet to be issued. There's a certain interplay of these rules with rules in US which seek to tax passive streams of income. How that interplay would happen is again something that there would be additional guidance in a short while in public domain, and there would be consultations around implementation framework. This implementation framework would talk about how consistently these the entire regime would be implemented, administration, compliance related to the entire gamut of matters would be covered as a part of the implementation framework. There is going to be consultation around this, and thereafter you are likely to see the final rules on implementation framework. What is the timeline that we have in mind as far as implementation of these rules are concerned? It's likely that applicable domestic law would be, or the domestic law in each of the countries would be amended in 2022. And these rules are expected to be effective 2023. UK has already brought out a consultation paper on what the model rules should and how they should be translated into the local law. Similarly, the EU Commission has also released a draft directive in terms of the proposed rules, basing it on the OECD model rules. What are the major changes from the previous publication? These rules were in some form and manner available for multiple public feedback, for consultation and feedback. Based on previous feedback that has been received, OECD has factored deferred taxes also while computing whatever is the effective tax rate. They have brought in certain additional checkpoints to ensure that hybrid instruments do not result in an increase in the ETR. One of the checkpoints that I talked about was undertaxed payment rule. There are certain allocation rules or mechanisms which were contemplated in the previous draft. That has again undergone a change between the previous version and the current version. The updated rules also talk about the local geography or the geography where the tax rates are below the minimum tax to bring in a top-up tax, whereby that geography would now be able to impose wherever there is going to be globe rules applicable. The local geography can say that I will up my tax rate to this 15% or a higher sum, such that that geography does not lose out on what is its rightful share of revenues, rather than let that go to another geography. There are a few things that come to my mind in terms of what one should bear in mind and what one should watch out. The first is to review the coverage and applicability to the set of companies you are working with. You may also wish to understand whether a particular country particular country is reducing this threshold. The framework says that while you have to introduce it for these categories of entities which have 750 million revenue and above, some countries may choose to bring the threshold down further. What happens if some of these countries bring the threshold down further? The applicability may increase. Some of the companies you're working with or advising may now have to look at the applicability of these rules. Impact of tax law changes owing to these rule changes. You may have a certain geography facing out an exemption or facing out an incentive regime or introducing a top-up tax. How does it impact the overall ETR of the group that you're working with and the compliance that is required? What are the adjustments that are required to be undertaken under the globe rules? You may want to do a dry run and see how this works and what is the kind of impact it has. These rules are perceived to be fairly complex. There are interplays, there would be further interplays between how pillar 1, pillar 2 will work and how it will work with certain CFC norms as well. So you may want to understand and assess how that impacts from a law to a mathematical translation standpoint. One other point that needs to be borne in mind is what happens when the rules are not in English and French. Today, OECD is contemplating or has issued rules in English. Very shortly, you're likely to see rules in French as well. What would happen when there is a rule that is being introduced in a different language? When rules are modified slightly, how would it impact the overall harmony and consistency that you would want to see across geographies? These are points which we will have to wait and watch. Can I take a few more seconds and quickly run through this, Bharat and Sudarshan?
Sure. Please, sure.
That's okay with you. I will stop with that. I'm mindful of the fact that I'm beyond the dot.
Yeah, maybe a few minutes.
I'll take that. Sure. Malaysia has released updated guidance on R&D. The reason I picked this is it is in some sense similar to what you would see and you are familiar with the treatment in India. Broadly or roughly similar approach is available. There is a double deduction in certain instances and a single deduction. This is not done is set out from the executive available. I have also set out certain changes between the prior guidance and the current guidance. I will not go into that owing to paucity of time, but I will share this document which you can take a look and understand the details between the two versions. There is a double deduction that is available for in-house R&D expenditure. This would require a few conditions to be satisfied. Things like you have to be a manufacturing entity, you would need approval from the Ministry of Finance, which of course has been delegated to other officers. But a certain set of requirements to be complied when you are claiming an in-house expenditure. You will get 2x of this R&D spend as a deduction. You also have the ability to claim a double deduction where you this entity which is undertaking R&D activity from the MIDA. The approving authority in the two instances is different. The approach that is typically adopted is also different. MIDA is the Investment Development Authority and therefore tends to take a little more benevolent and kind view of what is activity because they look at it from a slightly different lens. They do not look at it as a tax benefit but more as a environment that they want to foster. Having said that, while one may think that what is the downside in going in for a MIDA approval and why should one go in for a approval from the Ministry of Finance, which may be a little harder, you may wish to bear in mind that in Malaysia, you do not have a free flow of GST credits. For the double deduction, under the second category, it has to be a scenario where a unit or a business is registered as a R&D unit and provides services to another entity. The entity making the payment can get a double deduction of the payment to the R&D unit or the recognized unit. This, as a consequence, would entail the provider of service to bill the recipient, including VAT. And given that VAT is not a free flow in Malaysia, one would need to factor or do a trade-off assessment on what is the amount of tax benefit the company is getting from the double deduction versus the amount of VAT cost that it is assuming from the process. And in light of that, decide which one of the two options would be better. There are lower thresholds and easier ways to achieve a single deduction, but the benefit would be only vis-a-vis any capital expenditure that the R&D unit is incurring. You would see similar benefits under the Indian law, where for a in-house R&D unit, you had the 200% benefit. The first deduction that is similar to a case where you are making a contribution to another unit which is recognized as a R&D unit. Let us say a university or a R&D approved R&D center where you make a contribution. Earlier tax law had a double deduction for that. The second category is similar to that. And the third category is similar to the one where you have a write-off of any capital expenditure for a recognized R&D unit.
Seeing interplay issues that will arise. And especially, a couple of aspects which I don't know if time permits, I definitely touch upon, which Navneet also did as part of his update, which is on the globe rules. I must admit, like what Navneet mentioned, the last 1 week or so, I've been fully into globe rules, as part of the representation for a monitoring group. And it's been mind-numbing exercise. If one says income tax act is complicated, one should definitely look at the globe rules, and they'll feel income tax act is far lenient compared to what the globe rules are. But just a couple of observations on that globe, which is very far-reaching implications are: one, the qualified domestic minimum tax, which Navneet alluded to. I believe that has changed the complete equation and has put UTPR, the undertax payment rule, which it's no more undertax payment rule because you don't need a payment, you don't need an excess in the new rules. But of course, those are different topics. But all I want to tell is the qualified domestic minimum tax, which came at the insistence of Ireland, has completely changed the framework of Pillar 2 in my view. So it will be very interesting, especially from a developing country standpoint. I really, low income country, which normally has higher profit tax rate, I'm not sure how effective Pillar 2, unless the subject to tax code has a significant. Of course, as Navneet mentioned, I will not get into it. There are a whole lot of complexities. But one thing is, as for many, I wear dual hat, as what Bharat mentioned, accountant and lawyer. Chartered accountants will have a great role to play, considering the fact that the consolidated financial accounts are the starting base, and more importantly, constituent entity starting base is also going to be financial accounting. There's a whole lot of controversy going on. So that places a lot of emphasis on auditors, at the same time on accountants as well. So it will be a very interesting sort of interplay, and accountants can add significant value in that. So having said that, without any further ado, I will get on to my topic for today. But in fact, I should thank CTC for going into this topic, because somehow this has never captured the attention. But then 3-4 years back, had I mentioned this topic, I'm sure wouldn't have got at even consideration. But thanks to Vodafone and Kane, this has got considerable attention. So therefore, at least the concept of investment arbitration is among the mind of professionals. So what I'm going to do is, this is broadly going to be my agenda for today. I'm not going to get into aspects. You can have a look at it. So let me first set the tone. Why is this topic relevant? Because one fundamental aspect which I would also want people to answer. You can put your views in the chat as well. How many of us really factor bilateral investment treaties with, just like how much as tax professionals, as legal professionals, as accounting professionals, as business consultants, do we really factor bilateral investment treaties while advising inbound and outbound investments? You can give in, yes, I'll be happy to get some perspective, but fairly, I've seen very little significance goes into it. We're more keen on the FEMA guidelines, more on the FDI policies, tax treaties, tax optimization, but seldom, very rarely. I'm not saying nobody does it. Seldom, there's a consideration being looked into the bilateral investment treaties. But having said that, this raises another follow-up question: is why are they then entering? Does it really promote foreign direct investment? Does it have a significance? There are divergent views to it in terms of signing a bilateral treaty. Will it promote investments? Will it be a nudge factor? So therefore, the bottom line which I wanted to stress here is the role which BITs play in an overall scheme called investment. So it's not only the tax aspect, it's not only the trade aspect, how significant is the investment aspect, and tax couches under these aspects. Now, just to carry on with this discussion, how important is BITs? When I mean BITs, the bilateral investment treaties, I will keep referring to international investment law or bilateral investment treaties. And when it comes to tax treaties, DTAA, I will mention it as tax treaties. Now, does really BITs play a role in terms of attracting FDI from a developing country standpoint, or even from a developed country which is looking to attract investments, say like Ireland or Hungary? What is the importance of bilateral investment treaties for decision making? Quite a few projects have been recently working on it. One of the projects which I also bounced to Navneet was largely from an India BIT, which I'll come to later part of my discussion in terms of from an outbound, India outbound perspective, how much do we really give consideration to the existing bilateral investment that India has entered. But having said that, one of the surveys by economists, looks at which is very interesting results. Surveying almost 1,000 multinational enterprises, top 1,000, and interestingly, India ranks in the number 3. But I was expecting India to be number 1. When a country, when an investor enters into India, I presume India will be looked into number 1 in terms of do they have an investment protection treaty. Surprisingly, it's US and Canada which garners more importance, and Asia, of course. But you can see that India comes as part of 3. So, which really shows that multinationals do give a lot of emphasis while looking at investing into a host state. Now, on that same note, if you also see, the same survey which also indicates, what is the importance when you want to do a FDI? What are the types of legal, what are the important hallmarks, classifications, or factors that you will attribute to? Again, multilateral treaties come in the 3rd rank, so almost 3.9 from ranking out of 5 importance for multilateral treaties. But what is very startling here is, national laws play a major role. So more than having a foreign investment law, a political stability, having a clear-cut national laws which protects, and India's constitution does all these things as well. But having said that, companies, especially investors, look at these aspects when they get into the host state, which is largely the national laws, and then look at the labor law rights, the human environmental protection, and then last comes, the 3rd comes, which is again top 3, is the bilateral investment or the TRIPS related agreements. So all these, signify the fact that there is a need in terms of evaluating the bilateral investment treaties, as it plays a very, very significant role in deciding whether to invest in one particular state or not, irrespective of the market potential that state has. Now, continue with setting the tone, the relevance, apart from Vodafone gain, which come to it. The need for it is, as you can see, they play a major role in terms of evaluating from a businessman standpoint. Now, interestingly, as much as we are now familiar to Vodafone, Kane, probably from Tamil Nadu, familiar with Nissan, and of course, for those at Bangalore, needless to mention the Antrix Devas, which I believe we're going to have another round of investment arbitration coming in after Supreme Court has now recently said they have to wind up. So one more round of investment arbitration, in my view, awaits India. But having said that, from a tax standpoint, we've been having almost 150 cases. So you can see it in the screen as on 2020, the last study survey by UNCTAD, where there's, the inventory as of 2020, 31st December 2020, amounts to around 1,000 odd cases in the investor state dispute settlement, the ISDS case under the bilateral investment treaties. And out of which almost around 40 cases pertain to taxation. And these are cases which are not new, which are not, came up largely because of India's. And these are cases which have been prevalent for quite some time, starting, late 1990s, the later part of the 20th century. And so, some of the cases that largely in the tax ambit, if one may put it, if the bucket, when I mean tax, it's not necessarily the direct taxes or income taxes. The overall taxes as such, the cases have been for unlawful imposition of involving capital gains on sale of shares of another company, similar to the direct or indirect transfers, that is not the retroactivity, but similar to the indirect transfers or direct transfers. There's one more judgment that is expected anytime soon from the exit arbitration, is a Korean case where it involves a treaty shopping issue, Lone Star. I will touch upon it, where Lone Star, which is a US-based private equity, used the Benelux, used the Belgium-Luxembourg treaty to avail capital gains exemption. So it will be very interesting to see what is going to be the outcome of the tribunal. And then there have been cases on withdrawal of VAT subsidies, large number of issues coming up on energy tariffs, windfall levies related to oil and gas, and expropriation for tax recovery. So these are broadly, so the point is, we've always been having tax disputes under the BIT, and it is not a new phenomena because of Vodafone or Kane. So, having said that, one very interesting aspect on the previous slide was, if you see the number of tax cases against, it's not against the developing countries. Surprisingly, large number of cases lie against Spain. And of course, it pertains to VAT and tariff subsidy related aspects. And again, if you look from a number-wise, large number of disputes stay in the renewable sector, in the extractive sectors. Now, so therefore, whatever we have seen now, the rule of law is a top consideration which multinational makes at their decisions. All they're looking at, as we saw, as much as national laws are significant, at the end of the day, ease of doing business, stable political environment goes without saying. But the very important essential aspects they look at is rule of law. Now, this obviously has a significance to the Vodafone Kane issue as well. But then the rule of law, in a way, can be instilled or nudged through these bilateral investment treaties as well. Now, again, as I mentioned, it's the tax fraternity which has taken notice about the BITs, thanks to the Vodafone Kane award, the Nissan, and previously quite a few other, the Yukos case in Russia, which actually opened up, involved a lot of tax professionals into the investment space. Now, seeing the significance of the tax disputes that arise in the investment area, why does it arise? What is the friction? We're going to see it as we go along. But then that has also now become a huge subject matter, which the UN Tax Committee in the 17th session, which happened a few years back, came out with a secretariat paper in coalition with the OECD on tax, trade, and investments. So coming out with influence of non-tax agreements in the tax agreements. Now, a very interesting read. If you haven't read it, one should lay their hands on it. Stretching further on the 17th session, recently concluded last 23rd UN Tax Committee session, approved and voted to have a separate subcommittee to work on harmonizing tax, trade, and investments. So the role of non-tax agreements in tax, and it will also help vice versa as well. So, but this is what we're going to see today in terms of how it is going to help. One would always somehow, with many aspects, we've been looking in a silo basis or being compartmentalized. This is for tax professionals, this is for investment professionals, these are for audit professionals. But then sometimes, there are aspects which requires synergy and more importantly, working together, which is on the tax trade investment, and which is what and there are a lot of lessons to learn from all these spaces as well. Incidentally, as we speak, as much as a lot of activities are happening in the international tax world, which Navneet mentioned as part of Pillar 1, Pillar 2, BEPS, MLI, various aspects. The international investment agreement space or the international investment law space is also going through quite a lot of changes, and that initiative is by the UN. The UNCTR has taken up the UNCITRAL Working Group 3 is largely working on amending reforms of ISTS. Why does it need reforms? What are the issues? We will look into it. But all I'm trying to say is there are a lot of overlaps, interplay, and mutual learning from different fields, which all come under the single umbrella of international economic law. And not only on the international organization front, even academics in the recent past have shown a lot of interest. There's a very good note published by UNCTAD and Vienna University, where had a little role to play in the report as well, in terms of what should the tax policy makers look at while, as part of investment agreements. Now, one aspect, why there is a friction, why there is a mismatch or overplay, largely because of the fact that as much as we compartmentalize, the governments have also compartmentalized. Classic case in India, trade comes under the Ministry of Commerce, which the WTO aspect, and the DPIT, which does the FDI policy, also comes under the Ministry of Commerce. And the investment agreements are entered by the DEA, Department of Economic Affairs, under the Ministry of Finance. And I really don't know how much is the licensing happening between the CBDT or the tax, the tax policy, international foreign tax policy unit, and the DEA. Maybe going forward, we may see. The problem is also with the governments who have worked on silo basis, compartmentalizing their roles, clearly mismatched, because on one hand, the trade is very keen with their policy to attract investments or go with the WTO, but then the DEA many times, don't align with the trade aspects. And then the CBDT works on its own way in terms of negotiating tax treaties. So that could be the reason why we have frictions. And today we have issues in the form like what we are seeing with the likes of Vodafone, Kane, and the huge amount of time, energy loss to the nation in terms of money, in terms of energy. Now, having said that, one more point, which is why this topic is again very important, is Navneet also mentioned it as part of his update. What are the other aspects? Malaysian R&D tax was one which he mentioned. It'll be very interesting to see how that is going to pan out with Pillar 2 coming in, especially the Globe Rules mandates adjustment as part of the tax base for those credits. And more importantly, what will be the net impact? If it's going to reduce my effective tax rate, then in that situation, I'm going to come back and pay the minimum tax. But having said that, can a investor then go and say, look, Pillar 2 is discriminatory under the investment agreement. Very interesting issues are coming up. And can you say, look, I'm not being treated properly? Or will countries start entering into stabilization clauses, which we look into it? And more importantly, going forward, we may see more non-tax incentives being given. And again, that opens up WTO issues as well. So it's going to be, so all the more imperative that as professionals, as business advisors, we cannot be oblivious of the fact, even though maybe certain things are macro policy level, but then that will have a larger role for us, to keep our eyes. So my point is there should be some amount of bandwidth that we should dedicate towards this space in order to give a cohesive advice to our clients, even from a litigation standpoint. So having set the tone as to why this is relevant, not necessarily because of the the hooray the hoopla around Vodafone and Kane, but also in light of the Pillar 1, Pillar 2 developments, and the fact that a lot of harmonization has already happened between tax and trade, between trade and investment, and tax has been left out. So that's the last puzzle. So we're going to see a significant interplay between these three important aspects. So having set the tone on the significance of it, before I dwell into the technical aspects pertaining to what are the issues, tax issues that we encounter under the bilateral investment treaties, let's, for the sake of convenience, have a look at how the bilateral investment treaties framework are. This will, going to the fundamentals though, but then this will help us to appreciate, considering the fact that we already have a fair bit of understanding in terms of how international tax law framework works, especially tax treaty. So this will help us to reflect with the bilateral investment treaty and see if there are common points, common thread, or frictions, and how do we address it. Now, the bilateral investment treaties. Now, if you see, I use the term bilateral investment treaties, but elsewhere I mentioned about bilateral investment protection agreements. Previously, it was called BIPA, bilateral investment protection. So now just to go back in terms of how it emanated, after the First World War, to promote trade. Now, this has significance in the tax treaties as well, because the tax treaties also came about. The work towards the League of Nations work, the transfer pricing arm's length concept, all emanated post the First World War, when ICC set up, along with League of Nations, started to work on formulating tax treaties. So similarly, post the First World War, the US came out with the Friendship Commerce Navigation Treaty, basically to protect its investors post the war aftermath, and then in terms of aid they were giving under the Marshall Plan. So therefore, there was a need for investments to be protected. I use the word protected here. Subsequently, pursuant to the Second World War, the European countries, especially take Germany, lost a significant amount of its wealth in terms of compensating the Nuremberg trial, where they had to compensate. So therefore, they were very keen to get the trade more active, and they were very keen to start having an investment protection treaties as well, because they were worried whether any of the European counterpart nations will expropriate or take away their investments in order to offset for whatever that has happened in the Second World War. So therefore, they were very keen to protect, at the same time want to make use of the investments. And it was also a time during the Third Revolution where there was a lot of emphasis on extraction and process of raw materials. So as you may be aware, all these extraction process of raw materials are rich in developing countries or low developing countries. So therefore, they felt a need to have a protection. So therefore, they, incidentally, a German banker and a lawyer involved in preparing a multilateral convention for protection of foreign investments abroad. And then the OEEC, which is the now OECD, was supposed to approve the Convention on Investments Abroad. This was supposed to be a multilateral convention. For obviously the frictions due to the war between the European states and the US aid coming through Marshall Plan, it didn't work out. The convention failed. So therefore, Germany went out and then started its bilateral investment treaty in 1959. Surprisingly, its first treaty that it entered was with Pakistan. So that started the bilateral investment treaty wave. The reason for me giving this prelude is similar to international tax. We have a bilateral concept here. Of course, on the international tax, there was never a thought process emerged for having a multilateral treaty at the early stages. But bilateral investment treaties were contemplating to have a multilateral treaty, but eventually the proliferation happened through bilateral treaties where countries started to negotiate. And largely these were done with developing economies. Now, what is the need for the BITs? So as I mentioned, the need is largely because one, it was third revolution, there was focus on extraction. So they need to protect, they need to invest at the same time, protect to ensure that they don't get appropriated or expropriated. Now, after some point in time, even though at that point in time, not much of treaty proliferation happened, slowly the decolonization also happened from European. So that is also one of the reasons why they wanted to protect, because of decolonization, and many of these decolonized countries were still not happy with how they were being treated. So after a few years, so when the second world countries emerged, the second world countries here refer to the communist. They came out with saying, hey, look, what is happening through these investments is nothing but neo-colonialism. So they set up this new economic international order, which India was also part of it. Indira Gandhi was an active player in the new economic international order. So the economic nationalism or communism started to prevail, and there was also a famous professor Calvo, whose doctrine came in. According to him, he said any investments in a host state should be regulated only by the host state, and you cannot get into an international agreement. So this wave spread, and a lot of Latin American countries started to expropriate, especially oil wells and other aspects, bank accounts, properties, assets of the developed economy. So therefore, there was a lull. But then once the Cold War ended, the fact is, again, we had a lot of independent countries. The third world countries, the developing countries, then realized, as much as they can be self-contained, but they realized there's a need to attract investments, and therefore they started to pitch themselves for attracting investments, for which the first condition put forth by the developed economies was sign a bilateral investment protection agreement. Now, fast forward, today the significance of BITs has evolved a lot. It's no more protection, it's also promotion, because the protection is, today we are in a neoliberalist era, so therefore the importance of promoting investments play a major role. The global value chains that has, again, as transfer pricing professionals, we know how much significant the multinational enterprises, and if you take almost 60% of the trade, world trade, happens between multinational enterprises. So therefore the value chain required to have a bilateral investment treaty mechanism which protects as well as promotes investments, and not only protection. And having said that, today, if you look at the new generation, bilateral investment treaties are not necessarily bilateral. There is a shift towards, harmonizing trade and investment. So that's what I meant earlier, that trade and investments have aligned a lot. You can see from the RCEP, which as India, we would have seen this. India is not a signatory to the Regional Comprehensive Economic Partnership, but then the RCEP is an example. The RCEP has an investment chapter as well as relating to goods and services, trade-related aspect. And therefore, today we are having a lot of free trade agreements, preferential trade agreements. Recently signed Pacific Alliance by Singapore with few countries. In Latin America, you have the CPTPP, which has around 11 countries in the Asia Pacific, apart from US. And then you have the USMCA, US, Mexico, Canada. So a lot of preferential trade agreements, regional trade agreements, economic partnership agreements. India is also have now recently, noticed that started to sign FTAs. India UK FTA and India Australia FTA, and incidentally India New Zealand FTA, which we never have. So these are some of the major developments that's happening, and all these agreements will not necessarily focus on trade, will also focus on investment related aspects. One very significant aspect here is many of the bilateral investment treaties or protection agreements, when it was started, were only helping out in a post-establishment phase. That is, you invest and then we will protect you. But the modern day bilateral investment treaties give a pre-establishment rights as well. So what do you mean by that? Of course, India still does not have that, but many countries have started to, you have a FDI policy restriction. That won't, if you sign a FTA and which gives a pre-establishment rights, then probably you can surpass the FDI restrictions that you have in your home country. So broadly now they're looking at pre-establishment phase with some adequate safeguards as well, the positive list, negative list. I'm not getting to the nuances of it, but the bottom line is there is attraction towards attracting trade and investment as a one single package. Now, as you may see before your screen, what are the objectives from an investor? The home country of the investor, investments get protected. There's a maximum rate. Investor privileges and benefits. The bilateral investment gives certain privileges and benefits. Repatriation of capital and returns. I can freely invest without any worry that investment will get expropriated. It also enhances diplomatic relationship. For example, India, UK, India, Brazil is one example. India recently signed bilateral, it's called investment facilitation and investment facilitation coordination agreement. And that was signed when the Brazilian president was here, and he was a guest for the Republic Day. So which again shows, there's a diplomatic relationship in it as well. And more importantly, less regulatory interference by the host country. On the fear that there is a bilateral investment treaty, so therefore the regulatory interference will be pretty less. And adherence to due process, which we will look into it. So these are the objectives from a home country, that is from an investor standpoint. Look from the host country, one which attracts the investment. From their perspective, which largely is capital importing states like India, it's promotion of foreign investments. We all know how much lives have changed after liberalization and how FDI have played a major role in development of India, including its personnel and professionals like us. New jobs, technical know-how, local industrial growth, increase in tax revenue. And there is also a belief that the bilateral investment treaties, because of the less regulatory interference, also rubs on to domestic entities. In terms of the regulatory chill, they call it, under the investment jargon. The states will be reticent in taking aggressive actions. India has been an exception. Let's not get into it. But the broader philosophy is to ensure that you are more disciplined, which will also rub on to your domestic investments, which augurs well to the developing country as overall. That was the objective. So therefore, there's a belief that these due processes, less regulatory interference will help good governance, rule of law in the host country as well. And as I mentioned, it also enhances international relations. So this is broadly the rosy side, the objectives that bilateral investment treaties are supposed to bring into the table. Now, as you may see, similar to tax treaties, there are around 3,200 odd bilateral tax treaties in vogue, and the bilateral investment treaties are no less, almost close to 2,600. And you may look from 1990 onwards, especially 1990 to 2010, there's been huge amount of bilateral investment agreements, largely from developing countries, which have attained independence or which have opened up liberalization, like what India has done. So you can see the flurry of activity. the amount of investment agreement. So as on date, we have around 2,600 treaties. Now, why do I need, as we saw, adherence to due process? Now, this was very essential because many times, what the countries felt, that is the investor countries felt was, they give promises. I go to that country and then they don't adhere to the due process. That is, rule of law is not maintained. As much as symbols, I'm sure many of us would have seen a sales pitch. Once the sale is done, the customer always gets neglected. So similar to happen, or the investor feel that he's not giving the right treatment. So therefore, having realized this, the bilateral investment treaty, if you see, if there is an unjust action that is happening in the host state, then how do I resolve it? There were three ways I can resolve it. One, early days, which was the diplomatic protection. That is, the home state and host state diplomats will come together, which is state to state dispute resolution. They'll sit together and try to solve the issue. But the only problem here is it's a diplomatic protection. And then you obviously know no bureaucrat would want to give up his country. This is something what we are seeing in MAP process as well. Why MAPs were not, mutual agreement procedure was not successful initially, is because the bureaucrats, at the end of the day, they are civil servants and they don't want to give up or they don't want to concede. They want to maintain their position or interest, if I may say, not their position. They want to maintain their interest. So therefore, there are a lot of issues in diplomatic protection. It didn't work out. There is no resolution of disputes. If I go to the local courts where I've invested, again, the problem is I don't know whether the local courts are specialized to handle such complex commercial disputes. Do they have the bandwidth? Do they have the proper framework? Are the judges efficient? Are the lawyers efficient? Can investors' lawyer come and argue? Like, for example, there are regulatory hurdles in India. You cannot do that. So these are some of the issues that you have in having to try to resolve the issues in a local court. So that's why you have this ISDS, or the International Investor State Dispute Settlement, which comes as part of the bilateral investment. Here, the issues are resolved by the investor directly before an international arbitral tribunal, which is supposed to be a neutral arbitration body, which will try to solve. And the major advantage that was foreseen in investor-state dispute is the depoliticization of disputes. Because you look at diplomatic protection, you look at local courts, an element of biasism will also be there, and probably politics may play a major role. But when it comes to investor-state dispute under the International Dispute Resolution and International Investment Law, it depoliticizes disputes, and more importantly, the cases will be handled by experts. So therefore, investors preferred having a investor settlement dispute system, or the ISDS, which is a very hallmark factor pertaining to the international investment law framework. Now, just sticking on I missed one slide in between. So that basically, not sure. So that slide, what essentially it talks about is the principles. As you would have seen, the dispute settlement is one of the major factors. The other principles, what else should I require? I require access. That is, I should come to a host country and then have an access to it. And I should, my case should be handled reasonably. What do they mean by reasonably? It should be treated in a fair and equitable manner. And then I should be treated in the same way, like how the domestic person, that state is the domestic entity or person is treated, which is the non-discrimination aspect. And then the other aspect is transparency. So what I mean by transparency is I should know what is the rule of law, what are the aspects that governs functioning. So basically try to have a legitimate expectation. So essentially, if you see the bilateral investment treaty framework is, one, you have an access, that is, I should give me an access to invest in your in the host country. And the substantive provisions are basically, I should not be discriminated. There should be a non-discrimination clause in it. I should be treated reasonably. That is, I should have a fair and equitable treatment. And then I should also have a proper due process, that is, dispute settlement mechanism. Now, this is what you normally find as substantive clauses. You look at tax treaties or substantive clauses are allocation of taxing rights, the provisions of capital gain, Article 5, 7, 9, 10, 11, 12. So similarly, in the bilateral investment treaty, in line with its objectives, the substantive clauses are, for one, as you see, the most favored nation and national treatment. Many of us in the tax world are familiar with MFN national treatment, which is actually a inspiration from the treaty.
Sudarshan, we lost you there for a minute. Sudarshan? Sudarshan, we're not able to hear you.
Say it again.
Just a minute, guys. We'll just wait for Sudarshan to come back. Navneet, are you able to hear Sudarshan? Hello? No, we are not able to hear you at all. Yeah, sure, no problem. Just a few minutes, please.
Professionals, as tax professionals, we are acquainted with. The other important substantive provision in a bilateral investment treaty is the fair and equitable treatment. This is something which, as tax professionals, we're not familiar with, but this is largely a customary international law inspiration. So, whereby the investors are treated in a reasonable manner in a host state. And this is obviously has been the subject matter of litigation in all the investment arbitration issues. Predominant number of cases are largely on the fair and equitable standard because, as you see, it's a very subjective terminology and has an expansive scope. And more importantly, Kane energy, the Kane tax issue, one, and the tribunal largely tilted in favor of the investor against India through the fair and equitable clause. So such is the impact fair and equitable can make in an investment treaty. It encompasses and gives a wide protection to the investors. Another significant substantive clause is umbrella clause. So this is like whatever notwithstanding anything above, I also, it's like a cushion. Anything other than that should also be observed. So if a host state, for example, says, it'll be very interesting to see how, for example, during COVID, mandatory lockdown, or employees should not be allowed. And if an investor wants to say, look, I've had a huge business disruption because of that, they may probably come under umbrella clause. May not be fair and equitable or MFN, but umbrella clause will help them to file a case against the host state for coming out with, especially these are state specific. I'm just giving COVID as an example. There could be counter views also saying, these are very essential for public interest, so you have to do it. But just to give an example, the umbrella clause gives such a wide power, residuary power to invoke any grievance that he has using the umbrella clause. Stabilization clause. Now, I'm only touching upon those major substantive clauses which are from a tax standpoint. Of course, of bilateral investment treaties, and also very relevant from a tax standpoint as well. Stabilization clauses. I'll tell you why I specifically mentioned stabilization. Normally, I wouldn't have, but with Pillar 1, Pillar 2, especially Pillar 2, it'll be very interesting to see what will be the impact the stabilization clauses. So basically, I invite an investor and say, I'll give you tax benefits for 10 years, or you start making profits, then you start paying taxes. In such a scenario, the investor goes one step further, the country goes one step further and says, while entering into bilateral investment treaties, you also ensure that if you change your local laws, you should give me appropriate benefit. That is, I should not get tomorrow, just like what happened to SEC on MATs, for example. I don't want a backstab. So let's get into a stabilization clause, and I will have this treaty that will be fixed till the tenure of the treaty. So this is what stabilization clause is. In the event of modification to the tax system or creation or elimination of new taxes not foreseen in the contract, which have an impact on the economics of this contract, a correction factor will be included in the production sharing percentage. So basically, it helps you from a non-escalation and other aspects. This is going to be very interesting from a Pillar 2 standpoint, where I've given some benefits. And now if Pillar 2 comes in, what will happen if stabilization clause is already there with that particular country? If I invoke Pillar 2, can they come back and sue me saying, you have violated the stabilization clause because you have agreed to this particular? So it'll be very interesting to see. That's why I wanted to stress upon stabilization clause. The other very important aspect, which again from a tax standpoint also has been disputed, is the expropriation. Now, the idea of the bilateral investment treaty itself is not to have any expropriation. So neither party may nationalize or expropriate an investment of an investor of the other party, either directly or indirectly through measures, except for reasons of public purpose, in accordance with due process of law and payment of adequate compensation. So you can nationalize unless it is for a public purpose and appropriate compensation should have been made. In fact, incidentally, India, at the time of nationalization, which Indira Gandhi was involved in, we did nationalize, not necessarily the public sectors, also through foreign companies were nationalized. But then from my reading, India did give due compensation, so we didn't have an expropriation issue. But generally, the expropriation clause helps the investor to ensure that the host country don't expropriate unreasonably. And the wordings are also very crucial, directly or indirectly. Now, many times what happens is expropriation done indirectly or in the guise of camouflage in the form of a tax measure. So by levying unreasonable tax or a windfall levy. So therefore, that is why from a tax standpoint, expropriation will be very necessary. And you'll also see the treaties that have been customized to this effect. Now, having looked at the substantive clauses where it protects from a most favored nation, non-discrimination, fair and equitable, expropriation, stabilization, and the other last aspect, key feature or a framework of an investment agreement is your dispute settlement, which is already dwelled upon. Now, very interestingly, having said that, we need an independent arbitral tribunal to resolve the disputes because it depoliticizes the matter, and more importantly, an expert tribunal looks into it. Now, what the framework did one step further is, countries entered the ICSID Convention, International Center for Settlement of Investment Disputes. So under the ICSID Convention, which ICSID is governed by the World Bank. Now under the ICSID, what is the main role of ICSID? Institutional and procedural framework for independent conciliation commissions and arbitral tribunals in each case to resolve the dispute. So basically giving a institutionalized tribunal framework. So institutionalizing the arbitration mechanism instead of having a ad hoc arbitral tribunal. You under the ICSID, you can get into a institutionalized arbitration, investment arbitration. Now, I've compared both sides. One is the ICSID and other is the non-ICSID. Now, reason for me doing is this: India is not a member of ICSID Convention. The ICSID signatory, which came into effect from 1966, has around 158 members. So that shows a huge number of countries, more than what the inclusive framework has. So that really shows many of the countries are in consensus. One could be the fact that it's with World Bank, which is supposed to be an inclusive organization. And the other aspect is the major advantage which ICSID gives is once the award is given, it becomes final. Which is what, if you look at the New York Convention under the commercial arbitration space, also gives. But however, there are, in India, you need to enforce these arbitrations award in the court to get its validity. But when it comes to ICSID Convention, especially, Article 54, this is like a final court judgment. So once the ICSID award is given, automatically it is final and it has to be put into effect. That's the biggest advantage, and also more importantly, the selling point of ICSID is specifically to this effect that you don't need to go back to your domestic registration, and you can always enforce the gold standard. Now, interestingly, then you may wonder why India is not a signatory to it. India participated in the negotiations, but then unfortunately or fortunately, India didn't sign the ICSID mechanism. The reason for India not signing was specifically this point. That is, why should an international court get the supreme prominence compared to a national court? And there are other aspects as well. They were also not very keen in terms of, for example, if you see under the New York Convention, which is today, if you look, one of the biggest disadvantage in an arbitration is everything gets challenged in the guise of exception to public policy. This is something which they had included, they had requested for, saying, no, you cannot enforce all the way, you cannot treat the final court judgments. There should also be an effect to ensure that when it comes to public policy related, the award should not get its recognition, which ICSID is not comfortable with. ICSID Convention says, look, the idea itself is you should not go back to your domestic court. So therefore, we not agree to it. But ICSID also gives mechanism under Article 53 where you can annul it under certain few exceptional situations, like if you want to do a reinterpretation, rework, but very rarely we have seen annulment happening. The other point which India didn't also were not comfortable is there is no appeal mechanism in a ICSID Convention. Unlike your WTO, where you have a panel and then you have a dispute settlement body, the appeal panel is also the appellate body. There is no such appellate jurisdiction in the ICSID Convention. So therefore, India, largely was worried about the public policy, worried about international law getting into favor of the domestic courts. Now you need to wonder, India negotiated 1960s. That was the time when not sure whether it was Jawaharlal Nehru or Indira Gandhi, but both of them embraced socialism. As a matter of fact, Nehru was very particular that not only Nehru, even Tatas and Birlas didn't want foreign capital. They said government should do nationalization. If you want, why should we get foreign funds? Why don't government invest? So therefore, there are other political and philosophical ideologies as well which played a role. But looking back today, I believe India has also revised its model convention, which we look into it. India should definitely look at signing ICSID, in my view, especially that there are a lot of litigations happening in the non-commercial, non-ICSID arbitrations, and everything comes back to the domestic code. The idea of arbitration itself is to declog the codes, which doesn't seem to be happening. Now, very quickly, what are the criticism and backlash ISDS had? The criticism largely came in from civil society groups in developing countries that many of the arbitration judgments were in favor of investors. And this again, the rhetoric that it was neo-colonialism, all these arbitrators were Westerners, and they went in favor of developed economies, the capital exporting, so therefore investors were favored than state. Lack of transparency, which is very true, because even Vodafone came, we really don't know what happened, what transpired. Even Vodafone judgment is still not available for us to look into it. I did file a RTI to understand what was the cost involved, legal charges that were paid. These are all taxpayers' money. Haven't got any response as yet. So there is lack of transparency. Commercial arbitration, transparency is understandable. But investor-state arbitration should not be transparent, should be open. But unfortunately, this is one of the criticism or shortcoming of ISDS. There are efforts that is being made for like signing Mauritius Convention for transparency, but we are very little takers for the Mauritius Convention. Long story short, transparency is an issue when it comes to investment arbitration. No appeal process, regulatory chill, as I mentioned, fearing foreign investor filing a suit against me in investor state. The country is not able to bring regulatory measures. And incidentally, post 2000 onwards, there were 700 odd cases. So post 2000, we saw proliferation of ISDS cases. There are various theories to it. Are these criticism valid? Again, it depends on which side you want to look into it. My personal view is I will not fully agree to these criticisms. There are partially true to it, but partially, if you see, it was also the fact that a lot of the cost of litigation was high because foreign law firms thought this is a great way for them to get involved, and they were charging exorbitant fees. And then, more importantly, lack of awareness, and also hurriedness as part of developing countries to keep signing the agreements without consultation process, without negotiations, without putting it into the parliament. Even tax treaties don't get placed in the parliament for discussion. So I believe the blame should also be in the developing country. So why I specifically mentioned this was after India started to sign its bilateral investment treaties post 2000, with many developing countries facing, South Africa, Brazil, Venezuela, they are not big fans of ISDS. They came out of ISDS. India terminated. I'll touch upon it. It's BIT. So the issue was because of a lot of matters. Actually speaking, the ICSID came out with a report saying arbitration in favor of state is 56% and arbitration in favor of investors is 44 balance. So you can see it's not investors, it's the arbitration, and the states get to pick arbitrators as well. So therefore, there is no question of biasism coming in. So there is, in my view, not much of valid criticism, more political influence than anything else. All these issues are due to government change, corruption. So therefore, to avoid the political, tone, these were instead other aspects were highlighted to say why ISDS is bad, which is not the case. Now, quickly, what happened? India's relationship with BITS. So as I mentioned to you, post 1990 onwards, after liberalization, India started. Until then, we had socialism, and during Indira Gandhi's tenure, we had this economic nationalism. We were not very particular for liberalization. And then post that, things transpired drastically. And India started to enter into BITs after that in order to give comfort, because India had a checkered history of nationalization. So therefore, the investors were also very particular that bilateral investment treaty is imperative, fearing India may go back and start nationalizing and expropriating. Nevertheless, we have not done. But having said that, almost 80 odd treaties that India has signed, including some free trade agreements like with ASEAN, Singapore, and etc. So all these basically give enhanced confidence to foreign investors. Now, when India signed its treaty with China, the press note said the agreement will increase investment between India and China. With Brunei, if you could see, it says the agreement will promote and protect investments from country for increasing bilateral investment flow. So all these things basically showcases the fact that India wanted to enter BIT is to promote investments. Now, did it bring investments into India is a question, and this is a question not only to India. So as I mentioned at the beginning, do BITs facilitate FDI? There are various studies saying no. Some studies says yes. UNCTAD says bilateral investment treaties do have a very positive influence on investments. From an India standpoint, we can see that majority of investments have come from Mauritius, Singapore, Luxembourg, with whom we all bilateral investment treaties. They may be for tax purposes, largely tax advantage, but more importantly, the investors were also particular that they also had protection from an investment protection side as well. So maybe we can say there was definitely impact of increased FDI coming because of BITs. Now, until 2011, things were good. India were in a spree of signing BITs. But post 2011, after the White Industries case, which is the trigger point, White Industries case was again the India-Australia arbitration, where what is very interesting in the White Industries case is White Industries won a domestic matter, but then the enforcement of the domestic judgment took a lot of time, and unfortunately, the investor waited 5-6 years, nothing transpired. So investor took the MFN clause under the India-Kuwait bilateral investment treaty, where it says agreement if the investor is being denied through effective means. So the effective means they're saying is, look, I've been denied a judicial award. So therefore, effective means of protection. They took MFN to such an extent to take it from India, Kuwait, and the arbitral tribunal agreed to it. Yes, this MFN is valid. It will be attractive to all the substantive provision. India, Kuwait has an effective means clause, so that will get transposed to India, Australia, and this is undue delay in enforcing the local judgment. So therefore, India was levied with a huge penalty, damages. Post that, Deutsche Telekom, Devas, now Vodafone came. India had, unfortunately, went through a losing phase. And as of now, if you look, India is a respondent state for 26 claims. Some are settled, some are done, but 26 claims against India. And there are 8 or 9 cases where India is the claimant. That is an aspect that one needs to keep in mind as well. Anyway, considering that we were losing a lot of cases, India, as a knee-jerk reaction and upset with what was happening, terminated around 58 bilateral investment treaties. Now, I believe this also has an impact on the tax arbitrations. Somehow, India has been very vehement saying, we're not comfortable with tax arbitrations. Even the Web Section 14. I believe we have been getting largely influenced by the bilateral investment treaty experience. Just because India had a bitter experience with one economic law doesn't mean that we should have. So I believe we are just closing our eyes without looking at seeing how we can resolve tax disputes through various means. So this is the reason why I believe we've been unfortunately not able to look at it in a very broad dispute prevention manner or dispute resolution manner, and they're just sticking out to MAP, not going to arbitration because of our bitter experience with BIT. I believe we should now look at it with a renewed spectacle and see how we can learn from the BIT experience. Now we can do a better arbitration framework, which is always possible now that it's a different India as well. But anyways, I believe these are the reason why we are still skeptical towards arbitration. And as part of knee-jerk reaction, not only terminated 58 BITs, we also came out with model BIT, India's model bilateral investment treaty, which will be used as when the press note also said that BIT model will be used for renegotiation of existing BITs and negotiation of future BITs. Now, what is very interesting in that model BIT which we look into is there was no consultation. Again, this was done by the bureaucrats. Due respect to them, there could have been more open consultation, getting feedback, would have helped in shaping the new model BIT as well. Because at the end of the day, these BITs should balance the host state as well as the investor. It cannot tilt towards investor, nor tilt towards the host states. There has to be a balance, and the balance can always be achieved. It's not possible. Then that requires all the stakeholders to come together and do the negotiation, which unfortunately didn't happen. Nevertheless, as of now, we only have 4 takers to the new model. You can see all those countries. Brazil is the recent signatory to it. And India also insisted on having joint interpretative statements. This is very significant to me. I look at it in a very positive manner, because if these joint interpretive statements also if we are able to bring it into tax treaties, that will help. For example, the ongoing Netherlands MFN, countries can come. I'm not getting into the legality of it, whether it's a valid tool for interpretation. But that aside, this will give a lot of clarity in terms of what did the negotiators envisage when they entered into the treaty. So that could have been done, and that is a very good aspect in the joint interpretative statement, which India and Bangladesh have entered into. Bangladesh in old treaty, so they've come together and they've tried to clarify through the interpretive statement what was the object and what does that specific clause in the bilateral treaty reflects upon. Similar to what we have with, of course, the India-US is a technical release by US, but imagine if we have a joint interpretation, something like this, synthesize the text. Quickly on the India BIT model, again, a lot of very interesting developments. No MFN clause, which is very, very surprising, because MFN clause is the cornerstone for non-discrimination. And so there's no MFN clause, no fair and equitable treatment. So look, we are removing all the substantive clauses. No fair and equitable treatment, and that is replaced with a narrow clause, treatment of investments. Only these 4 aspects that will come under the treatment of, if there is a violation by India in any of these 4, denial of justice, fundamental breach, targeted discrimination, or manifestly abusive treatment, only in such aspects one can go to ISDS. Only if there's violation by a host state on these 4. These are, in fact, just manifestly abusive treatment, not even manifest arbitrariness act. So very, very narrow threshold. And very more importantly, taxation has been carved out, compulsory licensing under the TRIPS, which is now very essential, especially when India were fighting for remdesivir. Anyway, not getting into details of it, but what matters to us is the taxation carve-out. So tax has been now completely carved out of the India BIT model. And another very interesting provision that was introduced is obviously dispute settlement. And now what India has done is, if you want to go to, thankfully India has retained investor state, which is very good. You can still go to arbitral tribunal, ad hoc arbitral tribunal and the UN under the UNCITRAL rules. So that way India has not got out of investor state. For example, Brazil does not have a concept of investor state. Everything is state to state, similar to the mutual agreement procedure. Now, India says you can go to ISDS only if you exhaust your local remedy. And they've given a 5-year time limit. 5 years is pretty huge again. if you exhaust a local remedy, once you have exhausted, only then you can go for arbitration. So there was previously, for example, the ASEAN agreement said you can directly go to the give a notice and go to the investment tribunal. Once you have opted for it, you cannot come back to domestic. So basically, a fork in the road provision. So you cannot choose this or that. That cannot be forum shopping. Similar to MAP. Once you have opted for MAT, you have to wait. You cannot again choose a domestic court. So therefore, the idea is you can choose which this or that. But now what India has done is 5 years. You don't have an option. Come to my domestic court, solve it. If you're not able to do it, then after 5 years, go to arbitration. And state-to-state dispute is also introduced. That is, if there's a treaty interpretation issue, then it has to be only through a state-to-state, which is again very, I would say, unreasonable, because you can go to ISDS only for these 4 violations. So all in all, what it shows is India prima facie looks like they have come out with a new model which largely tilts towards the state than the investors. So very quickly with this, I will touch upon some of the tax aspects, and I'm running short of time. How long do I have, Bharat?
Sudarshan, you have around 15 minutes, Sudarshan.
Oh, okay, thank you. So now quickly getting into the tax aspects. Now, you would have seen by now, the reason for me spending some time on investment treaty, now reflecting now that on tax treaty, which we're already familiar with, there are some common elements. Like if you see the MFA non-discrimination is there in tax treaty. Of course, the investment treaty has one step further, the fair and equitable treatment. Primary source of rights are same, taxpayers government, investor government. Treaty shopping, it is possible in tax treaty, also possible in investment treaty. Other treaty entitlement, yes, we have the PPT, LOB, also have Article 1 to 4. But investment treaty, there's something called denial of benefits, very rarely invoked, because all these investment treaties are ex post, not ex ante. Unlike tax treaty, where we look at before applying whether it's the treaty entitlement. And are they both barriers to investment? That is tax investment. Yes, they are barriers to investment. So therefore, you need clarity on that. And both tax treaty, a primary purpose is to relieve double taxation, double non-taxation, but also including economic promotion. Investment treaty, protection of investment, but also promoting investments. Now, very interesting differentiating factors are the governance aspect. If you largely see, the current model treaties of tax are driven by OECD. And OECD is taking the lead on Pillar 1, Pillar 2. And some we can indirectly or directly say they play a major role in governing the international tax law. But when it comes to investment treaty, there are no governing bodies like ICSID is only a dispute settlement center, but all the other things are state dependent. Countries independently negotiate in other aspect. Another major aspect and why investment treaty also is undergoing a lot of reforms is, if you look at tax treaty, thankfully, our treaties are largely homogeneous because inspired from OECD majorly and a little bit from UN. So there was a recent study which said 80% of the tax treaties are identically worded similar to OECD Model Convention. So which means not much of variation. So that is one significant aspect in tax treaty. The languages are largely similar, here and there subject to some negotiations. But more or less, all 3,200 treaties, 80% have a same wordings. But that's not the case with investment treaty. More than 60 odd models as on date, including India's new model. Brazil has its own model, as I mentioned, which does not believe in ISDS. India's model we saw, Netherlands, Belgium, Colombia, each have the UK. Canada has a very interesting foreign investment protection agreement model. South Africa has its own domestic law. So therefore, bottom line is there are various different models, and that's where the confusion is, and that's where interpretation, the arbitral tribunals coming out with varied aspects makes investment treaty slightly messier. And that is one thing which the investment treaty is looking to learn from the tax world. I believe they are looking at a multilateral convention as well, and they are taking inspiration from the BEPS MLI. So you can see there are a lot of aspects, and the another aspect which I want to bring to your attention is the interpretation. Our interpretation is largely the OECD model convention commentary, but investment treaty is largely governed by public international law principles, mainly under the VCLT and customary international law. This is something, an area which I think India should definitely, the tax world should definitely look at and try to have a more broad-based, standardized, which is coming under the BEPS MLI. If you see, the minimum standards are helping. But I think we should slowly start getting towards a public international law interpretation across verticals, tax, trade, or investment, which will give more harmonization and clarity, certainty, simplicity for all the stakeholders. Another aspect is the dispute settlement, which I've dwelled upon a lot. Tax treaties are state to state through MAP, but whereas the biggest advantage investment treaty has is the investor can directly sue the host state. Now, where does the friction between tax comes with the investment treaty? Now, interestingly, if you see, as we all come from the tax world, there are no mention of investment aspects in the tax treaty. There's nothing to do with investment aspects. But if you look, investment treaty talks about tax and also tax treaty. So therefore, investment treaty has tax couched under it, not the other way around. Now, one of the reasons why people include tax in investment is they believe by including tax measure in bilateral investment agreements, their tax treaties will be adequately followed. If that tax treaty is not followed, they always know they have a backdoor entry through the investment treaty mechanism, which is what Vodafone, at least in India's case, used it. You use your tax treaty properly, follow good faith, other aspects. If you're going to abuse it, you're going to do state doing a treaty abuse, then okay, I will then have to look at the alternative entry, which is the bilateral investment treaties. So that is also one of the reasons why they include tax measure in BITs as a safeguard, stopgap, or basically safeguarding mechanism. So that way, the countries use their tax laws and adhere to the tax treaties. Now, what generally are the expectations of tax measures that they're looking at is, legitimate expectation. That is, you treat the tax measure should be reasonable, the fair and equitable treatment, provide tax incentives, whatever you have committed to, you give it to me. So that way, contractual equilibrium as well as economic equilibrium is maintained. That is, you say that you pay tax only when you start making profit. You may not adhere to it in your tax law, but at least through bilateral investment treaties, you will try to agree to it. So the equilibrium is maintained from a contractual, from an economic standpoint. Tax stabilization clauses, which I've already dwelled upon, that is, they don't go back tomorrow and change the tax rates, which will jeopardize my investment. And non-expropriation in the guise of tax should not happen. Now, this raises a very fundamental question. What is a tax disputes? When we have tax treaties dealing with tax disputes, then what is the scope of tax measures under the bilateral investment treaty? This is one of the major issues that happened in Kane, and that happens in all the tax matters. If it is a tax dispute, then go to bilateral tax treaty. If it is a tax-related investment dispute, come to bilateral investment treaties. This is very lucidly differentiated in the Kane Energy judgment. There are also other judgments which has dwelt on this. If you look at the Kane Energy judgment, para 793, a tax dispute is one which is concerned with whether and how a particular transaction is taxable under the applicable law or possibly laws of several countries. The transaction, how a particular transaction is taxable. Tax-related investment dispute, on the other hand, the right side of the screen says whether the respondent state has breached substantive standards of treatment under the investment treaty through the exercise of its authority in the field of taxation and whether liability arises as a result. So therefore, what essentially they have mentioned is, if it is a tax measure, for example, the Duke Energy case, also says this. This is an issue regarding customs duty. So this is a tax dispute. Bilateral investment treaty does not have a jurisdiction. Duke Energy is a very old case, came in 2008, I believe, which Kane Energy also relied upon. So that's a clear case of customs duty. But if another principle, if you see in Occidental versus Ecuador, was on the face of it, it looked like the VAT issue. But then the tribunal said whether there's a right to refund of taxes which is levied unduly. So therefore, this was classified as a tax-related investment dispute. So therefore, in nutshell, what do you see a tax measure is? A taxation measure would largely be if it is governed by the taxation law, that is which imposes a liability to the state for public purposes. And if it pertains to that particular tax measure, tax dispute, then the bilateral tax treaties will take over. But if it, through tax, if it has breached certain substantive standards of treatment, then in such a scenario, it will come under the bilateral investment treaties. And Kane Energy alluded this very explicitly. I've also indicated few judgments. For example, the Cavalium in Spain, the recent one, it says first a measure needs to be characterized as a tax under the host state's domestic law, and it needs to be a tax under international law. Both has been satisfied, then it goes to tax treaties. Otherwise, it will come under tax-related investment dispute. So this is basically, there's a subtlety involved. So obviously the tribunal will have to interpret it in a specific manner. The Antares Czech Republic case is very interesting. It says tribunal must make a decision in light of the relevant facts rather than simply adopting the contracting state's own formal characterization. So a state cannot, just self-judge. So Antares judgment clearly says the tribunal should look into relevant facts, which is also what happened in the Kane Energy situation. Retrospectivity. It's not the question of tax, it's the question of retrospectivity and going against the rule of law. Now, how can this overlap be avoided? On a broad principle level, there can be a complete tax carve-out in the bids to avoid overlap. That is, bid scope will clearly say taxes have been carved out. You can see this in the India BIT model. So tax carve-out is possible through subject matter. What I mean by subject matter is the scope of the treaty itself will remove taxation. Then obligation specific, I'll come to this. That is tax excluded only for MFN treatment. Tax included for or carve out for expropriation. So therefore, these are obligation specific exemption. Now, the problem that is happening is the treaties are not consistent. Some treaty have, we'll look at into some quick examples, but largely treaties have partial carve-outs. Some majority of the treaties also have a clawback. That is, it is tax will not be there. Tax has to be carved out for MFN, but will be included for expropriation. So therefore, not all treaties have a complete carve-out like what the India model has. India model, BIT model 2015, completely carves out tax. So which means there is no question of going to bilateral investment treaties going forward. This was also there in the ASEAN agreement. The provision of this agreement shall not apply to matters of taxation. It shall be governed by avoidance of double taxation. India, Brazil has. Colombia model doesn't include tax in the bilateral investment treaties. Canadian model 2021 also completely carves out tax, but they also have clawback provisions. I'll quickly look into it. Now, other variations of carve-outs, that's why, so the point I'm trying to drive here is you have to look into each treaty and see. For example, the big disadvantage in the Kane Energy which India had is there was a tax carve-out. It was there under the national treatment and MFN. There was no tax carve-out for fair and equitable treatment. So which is what the tribunal would have said in para 797, 799. Nothing in the ordinary meaning of language of Article 9 of the BIT suggests that tax-related disputes fall outside the scope of tribunal jurisdiction. In particular, it does not contain any explicit exclusion for tax-related investment disputes. So this is the problem India faced, because Vodafone Kane both invoke fair and equitable treatment violation as one of the claims. And there are some treaties which carve out direct taxes, specifically indirect taxes included, for example, NAFTA. I'm not going into it due to lack of time. And if you can see here on partial tax carve out with clawback provision, for example, US Ecuador, it says very interestingly worded. I like it very much because it says, with respect to its tax policies, each party should strive to accord fairness and equity in the treatment of investment. So it says, even for tax policies, there should be fairness and equity. Nevertheless, shall apply to matters of taxation only with respect to the following: expropriation, transfer, observations. That is, if there is an expropriation done through taxation, then you can come to BIT. So therefore, these are some of the variations. As I mentioned to you, there are different models. So there are no standard, multiple variations. One should also look at the Canadian model. It's available in the public domain as well. Please have a look at, this is a very interestingly worded 2021 new one, taking into lessons that it learned from Vodafone, Kane, and various very detailed taxation measure clauses. I will not get into it, but what it says is, it also talks about grandfathering, and it also specifically mentions if there is inconsistency between FIPA, which is Foreign Investment Partnership Agreement, Protection Agreement, and DTW. DTW will prevail. For national treatment is applicable except for capital gains. So they have, they have tried to make it as explicit, so there is no room for arbitral tribunals to interpret. And if there is an appropriation case, then the claim should first go through the tax authorities. The tax authorities should first determine whether it is that is, both the tax authorities will determine whether it amounts to appropriation, expropriation. If so, then it can be allowed as a investment arbitral claim. So therefore, a lot of detailing has been done. A very, very good model to emulate. Finally, I'll conclude with what are the lessons that we can learn. When I mean we, the tax world can learn. There are a lot of things. Investment law can also be learned. You can learn from tax, but tax law can learn in terms of harmonizing with the investment law, because as I mentioned, trade is harmonized with investment. So it's high time tax also gets harmonized. And more importantly, the international tax law still doesn't follow much of the public international law. It's still largely dependent on OECD commentaries and other aspects. So I think we should start following DCLT, even though at times we do use good faith often. But then with multiple treaties going forward with Pillar 1, SCTR amendment, Pillar 2, already there are questions as to whether Pillar 2 is a treaty overreach. It's going to be very interesting issues that will come. So therefore, it's important we align with general public international law guidelines. The Kane Tribunal went on general public international law, which is fair and equitable treatment. And I think that should be part of tax treaties as well. It goes without saying, but it has to be specifically mentioned along with non-discrimination and MFN. Other issues we'll have is, recently we saw a Supreme Court judgment from Spain, which denied MAP in abuse cases. Now, this is going to be interesting because GAR, abuse, these are all, you can't have a very clear standards for it, but at least there should be some standard to be brought in. More importantly, this will now open the back door for ISDS issues. So therefore, MAP needs to be further strengthened. And finally, how about having a integrated international economic law court, maybe WTO or UN, where there are also, one school of thought, why not bring tax treaty issues under ISDS? Because anyways, they're handling tax matters. Put some appropriate arbitrators, expert. Why not let ISDS, already ICSID has a proper framework, institutionalized, clear rules. Why not do it? One school of thought. But then, looking at a larger picture, why not have a common economic law code so that when one's harmonized, we all speak the same language. Stabilization Clause has been given effect to. Yes, there are a couple of judgments which I'll share it across. Stabilization Clause was looked into in renewable energy subsidies. So yes, not on the direct tax. The termination of it, has it turned the perception against India? Yes, it has definitely, in my view, turned. But the other school says, look, we've been getting investments. So during COVID, we garnered a lot of investments. So all these BITs facilitating investments is just a myth. Yeah. But I still believe it will give a lot of comfort. I think you will see that in the going forward in all free trade agreements, we will see a more liberalized investment compared to the model convention. With the exceptions and excluding tax, we will not have situations. Yes, we will not have situations like Nissan, but at the same time, the problem we have is the state laws, state authorities should also know that they can always under even the TN issue was not with VAT, it's the way they went hard. So still there are rooms open for other, like for example, they can still go and say if there is fundamental breach of justice, etc. Still some interpretation will come into it. Yes, absolutely. Canadian model clearly indicates, and they have tried. In fact, Canada has Canadian investors has a large amount of investment claims made against Mexico, made against Latin American countries and African. So they are very particular to ensure that the Canadian model is watertight, so that it doesn't give room for tax disputes in BIT.
Understood. Understood. I had some more points at the start of the chat box.
Sorry, I'm not able to see that because I had to log out. I mean, I logged out. So.
Okay, no problem. I just read it out. So this is in the initial slides which you had shared. Any particular reason why for US and Canada BIT is a key determinant for investment? India was number 3 in that listing.
Oh, I don't know. In fact, that was a startling surprise for me as well. And even the economist, I will share that to you, Bharat. Even they had mentioned that they were surprised to see US Canada in the list. So they themselves were surprised, and so probably Canadian investors. See, the only thing is Canadians are always, US treats them as 51st state. So Canada is always, worried about US. So I believe the survey respondents would have been largely from vice versa, maybe non-Canadians and Europeans, maybe Latin America, I don't know. So, but yeah, that's a very interesting.
They don't have a very interesting statistic which you gave. Yeah.
Absolutely. And India was third.
Correct.
Very interesting.
Correct. Okay, I think this is an incomplete question. So basically, yeah, this I think you dealt with in the subsequent slides, Sudarshan. Unlawful nationalization, can it be challenged under BIT? So I think you dealt with that subsequently. Answer is yes. Do we have any such case, BITs involving Russia? Because UCOS was one of the earliest cases.
I didn't touch upon specifically because I believe UCOS has been badly quoted. It's a clear political vendetta between two politicians. And I would not be surprised if the tribunal was also. I mean, anyway, recorded. But yeah, so I think there are judgments also which says UCOS cannot be precedents as well because there are different. Factual altogether, expropriation in the guise of tax.
Super. I think that's all. Those were the only questions. Super. So thank you for a very interesting evening, Sudarshan.